Hey everybody. We are just experiencing some technical difficulties, so just give me one moment and we'll wait a couple of minutes for everybody to dial in and then we'll get started. Thank you very much. Hey everybody, can you all hear me okay? If you could just click the button here that says raise hand, that would give me some good feedback and that tells me audio's working properly. And then we'll get started in about a minute. Thank you for dialing in. I hope you're having a lovely day. Today, it's an absolute beautiful day here in San Antonio. Nice and sunny as always. We had a little bit of rain yesterday, but we are good to go and we will get started in about 1 to 2 minutes. I'm just waiting for everybody else to dial in. Thank you very much. Great. It is now 6:04. I think we should get started. We do have a crowd here. Well, thank you so much for joining me today. The topic for the conversation today is the owner suite, the exclusive privileges and benefits of hotel ownership, with hosted by me, Raza Khan, co-founder and chief investment officer of Qilla Capital. We'll tell you all about us in a moment. Um, I had a very interesting couple of conversations today with investors and just watching Bloomberg, seeing what's happening around the world. And we'll talk about it in a second. I'm just gonna share my screen and this way we can all follow along. Okay, here we go. Okay, so we'll talk about all this in a moment. So first of all, here's a disclaimer. Our company, Qilla Capital LLC, are pursuant to the 506(c) Reg D of the Securities and Exchange Commission. We are, and because of that, we can only solicit investments to accredited investors. If you're not an accredited investor, I would ask that you jump off. And if you're curious, you can always reach out to us individually. But this is something that our compliance team has asked us to put into the presentation. So we'll talk about the problem and why we're here today, right? Before we talk about the solution, let's talk about the problem. So what's happening around the world? We can all agree there are a lot of crazy things happening: wars, excessive spending, a lot of uncertainty. The big beautiful bill just got introduced through Senate, and it got passed through the House and the Senate. We now know that the debt ceiling has been raised by $5 trillion. So while we're trying to end wars and we're taking care of other countries and we're spending a lot of money, of course we're borrowing a lot of money. The other interesting thing that a lot of people may or may not know is that the dollar has lost 10% of its value in 2025 alone. I know that sounds crazy, but I read it and I researched it. It's 100% true. It's the dollar is having its worst start to a year since 1973 or 1974, one of those 2 years. So, which is interesting. So, what does that mean? That means that, sanctions don't work anymore. This is not a political discussion, of course, but it's good to get an idea of what's happening around the world. This way, we can, focus in on what's happening in the country and the economy. So, the dollar is losing its value. There's a lot of countries out there like BRICS. They're trading amongst themselves, and our petrodollar, the wealth that we have built around this currency is being depleted as we speak. So the next that brings us that segues us to the next point in the conversation, which is how the financial industry is flawed in nature, right? People work hard, they invest in their pension funds, they save money their whole lives, they buy real estate, try to create wealth for themselves and their family, hoping that one day they'll be able to retire comfortably. And in every way, people get, the taxpayer, the common people get taken advantage of. And one of the ways is the like pre-tax and then post-tax. Now we're talking about the financial industry. The status quo of the industry is the financial advisor model. It is a flawed model. There are problems with it, like the agency problem. For example, that there's a typical 2 and 20 rule in the world of financial advisors and wealth managers, where they get 2% of your 2% management fee of just handling your portfolio. Plus, they take a 20% profit on anything, all profits that are generated on your portfolio, any gains on your portfolio. So as you can see, that's kind of concerning, right? The world is getting disrupted. Technology is changing the world. A lot of big industries that used to be titans as industries don't exist anymore. For example, the taxi industry doesn't exist anymore. And that is, Uber came in and disrupted. A lot of technologies are disrupting the world. Yet the financial industry is still somewhat undisrupted. Most of the wealth in the country still sits with financial advisors because people like to work with people they like and they trust, simply, even if it costs them more money. So these are some problems. Now, if you're a sophisticated investor that has invested in syndications before, I'm just going to check my mic and make sure it's working. Okay. If you are an experienced investor, a sophisticated investor that has invested in syndications with multifamily fund managers or real estate developers, etc., there's a problem there too because they also take management fees. And you know what? You know how I know? I used to be one of those people. I was a vice president of a fund based out of Florida before, and all I was taught my whole life is that, hey, as syndicators and fund managers, our job is to provide products. Investors invest in products. We make our profits based off of fees. But now at Qilla Capital, we're not doing that anymore, and we'll talk about that in a moment. Now, mediocre opportunities, what do I mean by that? I mean 70% of the fund managers that are actively raising money right now are doing it for the multifamily asset class, which we believe is very mediocre. Sure, it's backed by human demand, of course, and we are becoming a renter's nation. But the number of amazing, juicy opportunities that are out there is less than limited because there are a lot of people that used to be single family investors. They own duplexes, and all of a sudden they started buying these apartments, and now they're raising money and self-proclaimed experts. And the returns may not be there, or they may require a lot of work to extract those returns. So that's a problem. Another type of opportunity that you see a lot of is, and if you're joining in, if you came from one of our Facebook ads, you'll notice that our ads are different because our message is different, and it resonates with you because whatever you've seen in the past is, exactly what I'm talking about. Development projects where they take your money for 3 or 4 years, and then most of the returns, the IRR, may seem juicy, but it's generated on a premise that things go according to plan. The cost of labor stays low, and there are no unforeseen circumstances or unforeseen challenges in construction or whatever. So what if there was a better way? And that's how we came into the picture, and we're here with you now to talk about that. So these are some failed promises. A lot of investors lose money with fund managers and syndicators, and sometimes they don't lose money, but they don't get what they were promised. While the fund managers, they get rich off of their 2% acquisition fee, 2% management fee, 2% exit fee. On $100 million raise, you can imagine that's a lot of money, right? They don't need to. There's no benefit for them to work extra hard if they're getting to get a nice little payday before anything happens. The new way is the era of disruption and value. Anytime there's a successful disruption in anything, the value must be passed on to the end user, and that's our goal. So our asset class is a very exclusive asset class, which we'll talk about in a moment. It allows you to invest like the 1%. And the reason why I say that, and of course, this is about hotels. So the reason why we say that is because if you look at private equity, they raise billions of dollars and they buy businesses across America and they fix them up and they increase the performance and then they sell them for profit, right? Real estate people do the same thing. Hotel is where the two worlds come together. Hotels are underwritten like real estate, and you can get lending like real estate. But when it comes to the performance and increasing the occupancy, increasing the average daily rate or the average occupancy, increasing the profitability is strictly in the hands of the operator. As long as the hotel has the right fundamentals in place and good location, good brand, etc. That's where we come in, and we'll talk about that in a moment. Point number two, preferred distributions. We've designed our product where our investors earn first and we earn last. Sorry, that's a bit of a tongue twister there. Earn first. So our investors eat first, we eat last, and that's one of the ways we can pass on value to the end user. Number three, greatest flexibility in the product. You can invest in a short-term or long-term hold opportunity as either equity or debt. So up until recently, we were strictly modeling this as an equity investment, but then we realized that a lot of people asked us and said, "Hey, what if I'm just concerned with knowing how much I'll get paid? I don't care too much about profits later on and the share of the equity later on. I just want to know how I can earn and generate superb returns now." So we made some changes and we brought another option to the table, which we'll talk about in a moment. The next point, no fees of any kind. Yes, you heard that correctly. No acquisition fee, no management fee, no disposition fee. We only profit when our investors profit because we treat them like partners. And of course, the best point, my favorite benefit is the lifestyle benefit that because you get to fractionally become an owner of a hotel, you are able to take advantage of the benefits that come with that. And that includes discounts around the world. Over 10,000 properties around the world that the Marriott Bonvoy program has. If you invest in our opportunity currently, which is a Marriott property, you will have access to those discounts, friends and family discounts, which are typically between 50 to 70% off. If you book right, if you book well in advance, you're going to probably get, closer to 70%. So this is the era of disruption, and that's how we've created the ultimate product for our investors, something that is so good that if they don't invest, then that's something different. So let's talk about the concept behind our company, Qilla. Qilla is a word which means fortress in multiple languages, Eastern languages, in Persian, in Hindi, in Arabic, etc. So we formed Qilla Capital to be the fortress of wealth preservation, capital preservation for our investors. So we're a commercial real estate investment and asset management company. We have a portfolio. We have an existing track record of over $100 million in assets under management. That includes hospitality assets and that includes healthcare assets. Okay. So we work with a lot of physicians. One of our partners is a physician. Maybe he's on the call, maybe he's not. I don't have not looked at that yet. I'm at the other screen, but those are our two areas of focus, healthcare and hospitality, because both of them we believe are recession resistant industries and sectors in the economy, and they do well. They do really well as the economy booms. Obviously, hospitality booms because people travel and business travelers travel. And healthcare, of course, is a basic human demand, and the demand for healthcare it's expected to go up more and more as the population ages and the baby boomers they retire, and that's one thing they need access to. That's healthcare. So our investments, the 506C, we'll talk about that in a moment, eligible for retirement accounts. So our mission is, like I said, to be the fortress for capital preservation and giving you steady, reliable growth All our opportunities deliver cash flow from day one, and that's what makes it unique. That you get to participate in something that gives you a dividend as early as quarter number one, and the moment you sign the documents, actually. So we'll talk about the Qilla advantage. So proven track record, number one, proven strategy. And the strategy is the cash flow first mentality. We only acquire assets that we've done a thorough due diligence on. We've gone down the checklist. We make sure that the brand is right, the location is right, the demand drivers are there. We call it the Qilla formula, which means like we only invest in assets that are located close to demand drivers. For example, our two hotels in Laredo, Texas, on the border, near the border, they do really well, and the reason why is because we knew before we acquired them that there would be a demand by the government for the National Guard or the border services. And right now, one of those hotels sees an average occupancy of over 95%. And if you don't believe me, just Google it. The Staybridge Suites in Laredo, you'll see that the average room, per night is like $350 because it's just not available. They're all booked up all the time. The National Guard has taken half of the hotel, that one and the other one as well. So demand drivers, very important. Okay. Track record, very important. Having that operational excellence under your belt, very important. Having the experience of working with brands like Marriott, Hyatt, IHG, very important. Investor first. Okay. This is something that makes us unique. Personally come from the world of fund management where I have designed and promoted different investment opportunities for investors before. As a matter of fact, I wrote a book back in 2022 called Recession Proofing 101, a guide for accredited investors. And that book made the argument that there would be a massive downturn, rates would go up, all that stuff. And it came out to be true. I'm not a rocket scientist, but somehow I just knew that would happen and it would impact investors. So I wrote a book on how they can safeguard themselves and reduce risk. And the same thing we do now. We have an investor first approach. We design the ultimate flexibility and the ultimate product that checks all the boxes. And of course, we care about our investors. They're like a family and they become a part of our investor family. They get access to a concierge service for travel. That's how they get discounts, etc. And innovation driven. So innovation is very important, not being stagnant. I think we owe it to ourselves and everybody, the society, to create prosperity through innovation by designing better products, newer products. If there are unique advantages to be had, we want to pass them on to our investors, just like this fund right now, this opportunity right now, which allows them to take advantage of travel benefits, for example. And that's something we cannot even quantify in numbers, right? Some people travel a lot, some people don't travel a lot at all. But there's no limit. Our investors can enjoy that as long as they invest $100,000 or more into the fund, which we believe is very reasonable for the amount of value that they get. And of course, one thing I mentioned is also the fact that they can use their retirement accounts, 401k, IRA, or they can just use a cash balance. Our team is comprised of very experienced operators. Kuldeep Gyani, he is a very experienced operator in the world of business, entrepreneurship, hotel management, different asset classes. Right now, we have a couple of little assets that we haven't really talked about, like car washes, for example. And healthcare, there are 3 freestanding ERs, 2 freestanding ERs currently, one in Laredo and one in McAllen, and more being developed and more healthcare assets being planned in the pipeline. And that's how Dr. Pareen Shah comes in. He's our chief medical officer, and he oversees the portfolio of the healthcare portfolio. And this is myself, and I come from the Sorry about that. I had an issue with my internet, but I am back. I'm going to share my screen one more time. Okay. So here we are again. So I was saying why Texas is the greatest state for business friendliness, competitiveness, and this is what our portfolio looks like. It's all located in Texas, and we're primarily focused on South Texas. So that includes San Antonio, Austin, Laredo, McAllen, Brownsville. And we love this geography because it's right off the Texas Triangle and it kind of focuses on the South. And of course, as you know, there's billions of dollars of trade that happens through the Mexico border every day. And so that's what makes it unique. Okay, moving on. So our portfolio, I'm having a little bit of issues with my 1 second. So the pictures are not loading. Let me open that one more time. Here we go. So here we go. This is what our portfolio looks like at the moment. So some key assets worth highlighting: Laredo ER, Laredo, Texas does really well. Staybridge Suites, this is the one that I mentioned that sees a very high average occupancy. And then this is the Courtyard by Marriott located in San Antonio. So this is our only hotel in San Antonio at the moment. And some other properties worth mentioning. There's a McAllen ER in McAllen. There's an extended stay Laredo hotel, which is being converted into a Hyatt Suites as we speak. And this is going to be very unique because this is we're taking undertaking conversion to a very unique brand. The Hyatt brand, as we know, is it's a well-known brand, but the Hyatt Suites brand is a new kind of hip brand that they're modeling and they're showcasing right now. So this is going to be one of the first Hyatt Suites, in the nation. So which is kind of interesting. And some other interesting assets there. The ones in Brownsville. This is new development that's taking place. So our strategy is something that that's worth mentioning, and how we're able to deliver these amazing benefits to our investors. So location is number one. We have a specific criteria of what we look for that that, like I said, that are located close to demand drivers. For example, the Aloft Hotel, which we'll talk about in a moment, is a 6 minute drive from the San Antonio airport that sees over 11 million passengers every year. So a lot of traffic, and that's something that we are very strict on. So location, value add potential, okay, recession resistant sectors, and very thorough market analysis and due diligence. Okay. So we're happy to talk about this with you in detail. If you're interested, just please reach out and connect with me offline. Okay. So this is the legal entity, the vehicle that the all investments go through. It's a 506C Reg D registered fund with the SEC. And it's called Qilla Fortress Fund One because we believe that is the one word that can truly capture our strategy and our vision, and that's to be the fortress. So that means accredited investors that are interested in investing with their cash, LLC, or a retirement account. And there's a specific criteria that you must follow: 200,000 in household in individual income, or 300,000 in combined household income, or $1 million or more in net worth. Okay. So we'll talk about the opportunity now, which is interesting. I also recorded a YouTube video where I stayed at the hotel. Not sure if you had the opportunity to see that, but so this is a Marriott branded Aloft property in San Antonio, right by the San Antonio airport. Lovely property built in 2009, 141 rooms, and a very nice atmosphere. It's a budget version of the W Hotel. And if you know that brand, how everything is colorful and hip and jazzy, this is how the Aloft brand is. The hotel is located, like I said, right by the airport. It does very well on its own in terms of occupancy, but we believe that we can do a lot better, and with our own operational experience and guerrilla marketing tactics, so to speak. So the investment breakdown is the hotel is being acquired for $10.5 million. there's a property improvement plan, a PIP, for $4.5 million, which means every few years, as per the franchise agreement, the hotel owner must undertake a property improvement plan just to freshen up the place. New furniture, new electronics, new carpets, new everything. And that's how the brand stays relevant and fresh, and people keep coming back, guests keep coming back, and they pay a higher daily rate based on how fresh and crisp the hotel is. And then there's about 750,000 for operational reserves. That's about 3 months of operational reserves. There's legal costs and closing costs and franchise fees, and together it's 16,135,000. Now, the interesting thing that we're doing that not a lot of sponsors do is we're not raising any debt for this. So we're doing this as a 100% equity raise, and unless investors invest in the income product, the income fund, income note, which itself is a debt instrument, but we're not doing any bank financing for this, and it's 100% raised through the 506c fund. Okay. This is where the hotel is located, as you can see right there, right next to the mall, the North Star Mall and the Park North Mall. And the airport is very close by. The medical, all the hospitals in San Antonio are nearby. And one thing worth mentioning is San Antonio is the seventh largest city in the US, and it has some of the largest military bases. As a matter of fact, it is the largest military city in the nation. So for the Air Force in particular, all the troops that are trained, they get trained here, and all their advanced training, all that stuff happens here in San Antonio. So there's a lot of military travel. If you've ever flown through the San Antonio airport, you'll notice a lot of folks in their uniform. So that's another demand driver that we talked about as per our sort of criteria. So there are two options. Like I said, we wanted to create the ultimate product in terms of flexibility. So what we did is we're giving the investors an option of investing, through an equity fund, through an equity entity or investment, or the other one is the income note, which is a debt product. Two products, one is equity, one is debt, one is long-term, and it gives you a higher IRR over time. So for over 5 years, you get to enjoy an 8 to 10% preferred distribution, meaning once all the once all the expenses of the hotel have been paid, staff costs, taxes, maintenance, insurance, all that stuff. Once everything is paid and the profit is left over, the first tranche of profit is paid to the investor to make them whole on their preferred distribution. So 8% cash on cash preferred distribution for anybody that invests up to $500,000 and over 5 years. So it's a 5-year commitment. And anybody that invests more than $500,000, they get a 10% preferred distribution. Plus, they also get profit shares if there are any, over that 10% benchmark. And the target IRR is 13% for share class B, which is up to $500,000. And then it's 17% up for share class A. And in case anyone's wondering what the IRR means, the internal rate of return, that is something that factors in all the other profits or gains that are given to the investor. So in this case, it's the equity uplift. Over 5 years, our strategy is that we may, once the rates come down and the banks become friendly again, we may do a refi in year 3, cash out refi. And when that happens, we're going to pay the investors either a bulk or their entire holdings back. And then they'll still get to enjoy the distributions that are, in the deal for up to 5 years, up to the end of the investment, which is year 5. And all investors that invest 100,000 or more, they get the ownership privileges. They get the discounts at over 10,000 properties around the world. Okay. The second option is the income note. Now, this is for people that are not looking to invest for a long term. They just want a 2-year holding. That's something that they may be more comfortable with. In that case, it's very simple. They get a 10% distribution up to $500,000, and that's paid out on a quarterly basis. And then if they invest more than $500,000, they get a 12% coupon payment, which is paid quarterly. and they get their principal back at the end of year two. So obviously there's a slight difference between the two. If you're someone who's looking to invest for the long term and you know you love the product, you love the concept, you love the idea that we don't take any fees and it's a pure partnership model, you get to enjoy the equity ownership and the equity uplift when the hotel sells for more money down the road, then option number one is better for you. If you are looking for short-term liquidity and you just want a safe, reliable income paid to you, and you're not concerned with if it's equity or debt, then the second option is also great for you, the income note. Okay. The IRR on the equity is about 13%, and on this one it's about 10%. So there is more money. The equity investors definitely make more money, if just to clarify, over the term of the investment. That's what the pro forma looks like. And again, we can send you a more detailed breakdown on this if you're interested. This just goes over what the revenue numbers are like, what the projected expenses are like, and what the net operating income is like. And all you need to see is that there's enough here for us to cover the investors. And we're likely not going to make money up until year two. And we're okay with that because we get to acquire hotels. We get to break the scale that we're limited to, because and I'll talk about this in a second. Like, why is this such a great opportunity? Because what's happening in the world of hotels is that we're coming out of a pandemic hangover. Okay. What that means is during COVID, interest rates, the first response the government had was to inject a bunch of cash into the economy and lower the rates just to stimulate growth and the economy. So rates were low. A lot of hotel owners, they acquired, they did a cash out refinance. They at very low interest rates. They got to enjoy like 2.5, 3% interest rates, mortgages, non-recourse loans, meaning there's no personal guarantee. And now that the rates are high and 7%, 8%, they can't afford them. So they're just giving the keys back to the lenders. And if you know anything about banks, they don't like to operate businesses. Their business is to lend money and take deposits. And their first instinct is to clear their balance sheet so they can go back to their shareholders and say, we don't have any bad debts. So that's what's happening. It's a great opportunity to acquire branded brick and mortar, real assets, real estate, something you can touch and feel, something that already generates amazing revenues. And we get to do it for 60, 70 cents on the dollar. And that's what makes this a unique opportunity. And that's why we're doing this. Because we have our own portfolio, but if we can work with investors, it allows us to leverage other people's money to acquire amazing hotels. And in the process, they make amazing distributions. They get paid before we do. They don't pay any management fees, and they get to enjoy the ownership privileges. And we operate and we make sure everything goes well. So that is it. That is the end of the discussion. I did not have a very thorough agenda. I just wanted to kind of go and talk about what's happening and why we're here. And perhaps we will do more webinars down the road. If anybody has any questions, please raise your hand and I will be happy to answer your questions. And if you did not make it, or if you had, and I know I dropped off for about a minute, so I apologize about that. But what I will likely do is I will send this recording to all the people that showed up. And if you want to send it to your friend or family, anybody that you think can benefit from this, please share it, pass it on, pass it forward. And that is it. Well, thank you very much. If you have any questions, please type it here or raise your hand. If not, then we will conclude this webinar. No hands. I hear crickets, but that's okay. Thank you very much for your time, everybody, and hope you have a lovely evening and God bless. And we hope to talk to you soon. Bye-bye.